The 1929 stock market crash is remembered as an act of God, an unpredictable disaster, but it was the logical conclusion of a specific financial architecture. One man designed the system that triggered the Great Depression, and his blueprint still dictates how we trade today. To understand how he did it, look at the baseline of the American economy in the 1920s. Factories were turning out automobiles, radios, and consumer goods at a staggering pace, generating massive national wealth. Despite all that corporate growth, the stock market remained a closed club. Less than 1% of the American public owned a single share. Most people kept their money in savings accounts or bought government bonds. Then came Charles Mitchell. As the head of National City Bank, he saw those quiet savings accounts as an untapped resource, and he built a plan to bring the public onto the trading floor. Mitchell used the immense scale of National City Bank, which held more assets than the budgets of most nations, to turn the bank into a mass-market retail engine. He wasn't just holding money, he was selling the American dream. He created a subsidiary company to sell stocks directly to the middle class within ordinary bank branches. Suddenly, a customer coming in to open a savings account was met by a salesperson offering them a piece of the market. Mitchell staffed his branches with dream merchants, specifically trained in sales psychology. They ran ads telling streetcar drivers and secretaries that owning stock was the only way to become masters of their own destiny. This strategy targeted a new demographic. Families dipped into their life savings to buy into companies like Ford and General Electric. For the first time, millions of ordinary Americans believed they were on the path to becoming millionaires. Wall Street now operated as a high-stakes retail engine, drawing the life savings and emotional aspirations of millions into a single, interconnected system. The structural flaw in Mitchell's system was the 10% margin loan. It allowed citizens who didn't have much cash to buy stocks entirely on credit. An investor puts down $100 cash. The bank lends $900, creating a $1,000 portfolio. If the stock rises 20%, the investor makes $200, doubling their money. Margin loans spiked 425%, building a multi-billion-dollar pyramid of debt. This math was a trap. Because every dollar in the market was backed by only 10 cents of real cash, a simple 10% dip in prices would mathematically wipe out the investor and leave the bank with an uncollectible debt. By early 1929, the Federal Reserve recognized the danger. They issued a warning and demanded that banks stop issuing loans for stock market speculation. Charles Mitchell publicly defied the central bank. He held a press conference promising to provide all the liquidity needed to keep the expansion going. The market surged to record highs. 3 million more Americans rushed in. Families pawned jewelry, mechanics mortgaged their homes, chasing seemingly endless growth. Mitchell's decision to override the central bank's safety brakes meant the eventual correction would not be a minor downturn, but a total collapse of the national economy. The collapse began on October 24, 1929. Large institutional funds began a coordinated exit, selling hundreds of thousands of shares simultaneously. The sudden drop in prices triggered a panic that the telephone lines couldn't even process. Falling prices triggered a domino effect. Banks issued margin calls, demanding more cash from retail investors. When those investors couldn't pay, the banks sold their stocks to cover the loans, forcing prices down even further. The massive margin loans became uncollectible as stock values plummeted. The first banks to fail were those that had followed Mitchell's example. Across the nation, 5,000 banks closed forever. The human cost was immediate. Millions of Americans lost their life savings. Unemployment surged to 25%, and families found themselves living in cardboard boxes in sprawling tent cities called Hoovervilles. Despair hit the country's wealthiest cities. Record numbers ended their lives, while others stood in massive lines for free bread and soup just to survive. Mitchell had successfully brought the public into the market, but by doing so, he ensured that when Wall Street fell, it would take the entire American middle class down with it. The government responded with strict new regulations. They passed the Glass-Steagall Act to legally separate commercial banking from the risks of the stock market. In 1933, President Roosevelt took an even more radical step to regain control over the shattered monetary system. He he signed an executive order requiring all Americans to surrender their gold coins and bars to the government at a fixed price. It was a desperate move to increase the money supply and stop the deflationary spiral. The ultimate cost of Mitchell's system was the suspension of fundamental property rights. Americans had to give up their gold to bail out a currency system that had been broken by Wall Street speculation. Today, Mitchell's architecture has been digitized. The same debt-fueled system that triggered 1929 is now operating through our smartphones. This chart shows the current scale. 50 million retail investors are active today, and margin debt has reached a record peak of $900 billion. Modern trading platforms use zero commissions and gamified apps to push the same promises of easy wealth that Mitchell perfected a century ago. The mechanics of the system haven't changed. They have simply been scaled to a global level, making the potential for a localized correction to become a systemic collapse once again. There is a final historical lesson here. When the 1929 bubble popped, retail investors lost everything. But Charles Mitchell's bank survived, grew larger, and eventually controlled an even bigger share of the market. When you hear calls to democratize finance, look past the promises of easy money and ask yourself who is actually carrying the risk. The most severe economic collapse in history began as a mathematically engineered trap. Today, that exact same financial mechanism is sitting right in your pocket. In the 1920s, the American economy was scaling up at a relentless pace. Cities were erecting skyscrapers in months, and industrial production reached volumes that the existing financial system couldn't yet absorb. Out of a population of over 100 million people, fewer than 500,000 Americans actually owned stock. The stock market operated as a closed club for the ultra-wealthy, while the vast majority of the public kept their savings in standard bank accounts. This left an immense pool of working-class capital sitting idle. To the banking elite, these safe deposits represented a massive, untapped resource that needed a new mechanism to siphon it into the speculative markets. Charles Mitchell, head of National City Bank, designed that mechanism. He launched a campaign to turn every ordinary bank customer into a retail stock investor. Mitchell trained thousands of bank tellers to act as dream merchants. When a laborer came in to deposit a paycheck, these tellers were instructed to pitch corporate shares as a direct path to the American dream. This chart shows the primary tool Mitchell used to make expensive stocks accessible, the retail margin loan. Imagine a customer with $100 in cash. The bank allowed that customer to put down 10% of the purchase price, borrowing the remaining 90% directly from the bank. That $100 deposit instantly purchased $1,000 worth of stock. If those shares saw a 20% increase in market price, the investment gained $200. Since the customer only risked $100 of their own cash, the minor market movement doubled their money. Mitchell marketed this as financial empowerment for the common man. In practice, he was disguising a fragile mountain of bank debt as a new era of personal wealth. Millions of Americans began mortgaging their homes and selling physical assets to pour cash into margin accounts. People who had never seen a balance sheet were now obsessively checking stock prices as their paper profits grew. This line graph shows the result. Margin debt exploded by 425% in 4 years, reaching a peak of $8.5 billion. Every dollar in the market was backed by only 10 cents of real capital. By early 1929, the Federal Reserve realized this math was unsustainable. The central bank issued a formal warning to the banking sector, ordering an immediate halt to all speculative lending. Mitchell publicly defied the order. He held a press conference promising that National City Bank would provide all the liquidity the market needed, effectively overriding the central bank's attempt to slow the bubble. By dismantling the central bank's safety measures, Mitchell ensured that the inevitable market correction would trigger a total systemic collapse. The collapse began when institutional investors received word that the Bank of England was raising interest rates. Realizing the Federal Reserve would be forced to follow suit, smart money began a quiet, rapid exit from the U.S. market. On October 24, 1929, the coordinated institutional sell-off triggered a price drop that sent panicked crowds flooding into the streets outside the stock exchange. First, falling prices triggered margin calls, demanding immediate cash. Second, lacking funds, investors faced mass forced selling, accelerating the crash. Third, vanishing collateral caused banks to freeze all lending. Finally, over-leveraged banks went bankrupt, wiping out the savings of millions who never invested. The $14 billion loss on Black Tuesday mathematically vaporized the nation's entire credit supply in a matter of hours. The collapse left 25 million people jobless. Families who felt like paper millionaires now stood in breadlines, relying on charity to survive. Evicted families moved into makeshift shanty towns. Across major cities, the sudden loss of wealth led to a 30% spike in the suicide rate. The Brooklyn Bridge became a grim destination for those who had bet their entire lives on Mitchell's margin system and lost everything. Franklin Roosevelt entered the presidency as the US dollar entered a deflationary death spiral. To save the financial system, the government needed to print money, but they were legally tied to a gold standard that allowed citizens to drain the nation's reserves. In April 1933, Roosevelt issued an executive order to confiscate thousands of tons of privately owned gold. All Americans were required to surrender their coins and bars to the government at a fixed price, allowing the state to artificially devalue the dollar and increase the money supply. Reversing the damage caused by the margin crisis required the government to outright suspend the property rights of the entire American population. A century later, the breadlines are replaced by the sleek, neon interfaces of modern smartphone trading, but the underlying debt mechanism remains the same. This chart compares the 1929 debt bubble to our current economy. Today, 50 million Americans trade through apps, and U.S. margin debt has reached a record $900 billion, following the exact trajectory of the 1929 collapse. Modern crypto and stock platforms use the same language of democratizing finance that Mitchell used in the 1920s to encourage high-interest, leveraged trading. Systems promising effortless wealth for the working class rely on a critical hidden variable: who remains exposed to the debt when the mathematics finally break. To understand the hidden mechanics of global wealth, like and subscribe to Dollar Logic USA.